David Burrows is our guest from Barometer Capital Management. And even this time last year, when we were talking about top picks, you had cash as a top pick. You've brought it back again. What percentage of your portfolio is in cash right now?
You know, Michael, it really depends on the mandate that we're operating. Cash right now represents flexibility. And we're in a very range-bound market. And you have to consider that we are now 3.5 years off the lows from 2009. I believe we're in a cyclical market, and it doesn't pay to press hard in the 4th year of a cyclical rally. So I think that there is risk in the fall. I think that it does make sense to have some flexibility, and cash does that for you.
I've been told, 15% is a reasonable amount for the average Canadian investor to set aside right now.
I think that that's true. We're fairly fully invested, given the fact there are some key themes we can focus in. But you can't concentrate all in a few sectors, so we need to have some flexibility there.
Well, then let's talk about that. Allied Properties, top pick number 2. It's got a 4.4% dividend yield, a regular payout of 11 cents.
Yeah, so focus in parts of the market that people care about now. And that means yield, because everybody is yield starved. When I look at the REITs in Canada, they have a very, very low cost of capital, which is why they are growing nicely. Allied Properties has a very strong portfolio of Class 1 real estate, half of it in the Toronto market, and they are going through a process to intensify the use of that. So we think that they could get 10% distribution growth. They're just doing a JV with RioCan to do new buildings where RioCan will do retail on the main level, and they'll do office space on the floors above. And if we can get 4+% distributions with 10% growth in this environment, that's very attractive relative to other income alternatives.
Unit price, though, considered to be fully valued already at the $30 mark. You're basically clipping the coupon.
Right. We believe you'll see multiple expansion. Now, we've been on this now for 3 years, and it continues to be the case. Historical real estate valuations are being changed by the changes in the real estate market, the institutionalization, and so pension funds and other people are simply looking at real estate as a return versus what they could get in another long-term asset like a treasury bond, which of course is almost zero. So we think that that continues to be very attractive, and the risk spread we're getting paid is a good one with some distribution growth.
Tell me about that risk, though. At what point do you pull the trigger and exit the position?
Well, if we started to see deterioration in fundamentals, which we're not seeing, we're seeing improvement and near-term catalysts for change. If we saw price behavior that started to deteriorate either at the sector level, at the security level, or if we saw a beginning of a significant uptick in long-term interest rates. None of those things we're seeing right now. And the margin of safety is about 4% on the REITs versus a long-term bond. And that's no different than it's been for the last 4 years, despite the fact that prices have been going higher.
Top pick number 2 ties into this as well. It has about a 5% dividend yield, much like Allied. It's up over the course of the last year, double-digit returns. And the sentiment on the street is that maybe Interpipeline still has some upside, but I guess this also comes back to energy infrastructure that we discussed earlier.
It comes back to energy infrastructure as a key theme. We've recommended this one several times over the last 3 years, but we continue to because there continue to be near-term catalysts. They've just announced they'll do a $2 billion deal to expand pipelines to the oil sands to send condensate up and move bitumen back down. That could continue to generate 8 to 12% accretive growth, and that means we're going to get distribution growth continued, and so this is a theme we think continues to play out.
So the payout ratio is sufficient, and the growth rate that they're enjoying is such that that dividend is safe as far as you're concerned.
They can pay for the capital expenditures and get a very accretive cash flow growth, and we'll see dividend growth probably in the range of 10%.
Yeah, my screen here indicates it's a payout ratio of about 66%.
That's right. This is not a high payout. And we believe that over the next 5 years, oil sands production goes from 1.5 million barrels a day to 4.5 million barrels a day. All that bitumen has to be moved and processed. They're just enabling it.
You're pretty confident that the Americans are going to be okay with us building more pipelines into the States?
You know, unless you think they're going to want to ride their bicycles down I-75, they're going to want that oil.
So then I guess there's a political component to our investment thesis right now, the November elections in the States.
Yeah, certainly that can have an impact. I think that some of the positioning around pipelines is more politically near-term focused, and a lot of that, I think, can get resolved after the election, whichever party wins. So we think that that's less an issue than the market would place on it right now.
Now, as far as timing a market? I know you don't like to pick bottoms and you don't like to try to do that, but would we be, as average investors, better off to wait until we get closer to that U.S. election before buying in, or are these picks for today?
Yeah, I think that you can be pretty consistently picking away at the yield-oriented names. I think it's not impossible you get more news-driven volatility in this market through the balance of the year, and that's why we're being very careful not to be too economically exposed. We'll have to see.
Great having you with us, David. Thank you.
Thanks for having me, Michael. David
Burrows is president of Barometer Capital Markets Management. If you missed any part of the program, BNN.ca has the replay for you. And by the way, if you add /subscribe to the web address, you get the nightly newsletter where we send out the Market Call and Market Call Tonight top picks and analysis from our guests as well, and Marty Say's commentary on the market-moving stories. The special one-hour format continues all summer, an extra half hour starting at 1 p.m. Eastern, right through until Labor Day. Please consult a qualified financial advisor. I'm Michael Ainsworth.